Back to Carlson. He's free. He's in.
We got a whole new ball game, man.
"29-yard touchdown run. Ben Carlson, 21st touchdown of this, his junior season." And
Welcome back to Ask the Compound. On today's show, we're tackling questions about why the stock market has seen an uptick in volatility lately, with a little help from Jerry Seinfeld, what the next recession might look like, paying off low interest rate debt because of Dave Ramsey. Is that a good idea? How to create an investment plan for large gains when you're sitting on a large pile of cash on the sidelines, and the best way to sell your car if you're not named Michael Badnick and have a car broker of your own. If you have a question for us, our email here is askthecompoundshow@gmail.com. Today's show is presented by Rocket Money. Rocket Money is a personal finance app that helps you create and cancel your unwanted subscriptions, monitors your spending, helps lower your bills so you can grow your savings. Rocket Money has over 5 million users, has saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all the app's features. I like the planning aspect of Rocket Money. I was logged in my account this morning, and it shows the upcoming bills for the week, which is kind of nice for planning, but it also shows when the next payments will occur for subscriptions. I have a lot of subscriptions. Every streaming service. I have a gym subscription. I have some physical magazines still. I have a bunch of online subscriptions, and it tells you, here's when those payments will happen again, and so you can look at it and say, oh, wait, that one went up a little bit. I don't want that one anymore. This one, that looks okay. I'm good with it. And another one, that's too high. I'm going to renegotiate that. So I love automating my finances, but I still think you need to check in every once in a while, because that automation can get away from you if you just let stuff go and keep paying automatically without checking. So,
you know what I like? I just got a notification from Rocket Money that one of my subscriptions went up $2 a month. They snuck it in, and
Right.
Rocket Money let me know.
Yeah, and then you go in and negotiate and say, I'm going to quit. And then they say, how about we give you $5 off, and then you're good. Stop wasting money on the things you don't use. Cancel those unwanted subscriptions by going to rocketmoney.com/ATC. That's rocketmoney.com/ATC. All right, Duncan, this one's for you. John, throw up a first chart here before we get into some questions. Bloomberg had a story this week about leveraged ETFs, and they show this one is a triple levered MicroStrategy ETP, which is basically a levered version of a single stock MicroStrategy. That stock is up more than 110% this year. This leveraged strategy is down 84% because of the volatility in that stock. Basically, and it says this holds true on a 1, 3, 6 month basis. We get a lot of questions about this. Duncan, you asked me a question this week about them, and you
Right.
said, wait a minute, what about the triple levered NASDAQ? Like that stock may be too volatile for this kind of strategy, right? To work effectively. John, throw up the next chart. This does show, this is TQQQ. Duncan, you always ask me about this one. It's the triple NASDAQ 100, is that right?
Yeah, that's it.
So this is going back over the last 5 years. It has outperformed the regular Qs, right? But you can see, look at how quickly those gains can go away, like they did
Right.
in the 2022 bear
Oh,
market.
I was holding it.
So this fund was down 80%. So I guess the trouble lies in this. I have two words of warning about this kind of fund. First is that we've lived through an enormous bull market in tech stocks, and there hasn't been a ton of volatility along the way. Sure, COVID was some volatility, 2022, but the last 10 or 15 years has been pretty low on the volatility scale, especially for tech stocks, and the returns have been amazing. So you could go through a period of choppiness where returns are okay, but there's more volatility, and this kind of strategy gets you killed. That'd be my worry, that it's not going to be as bad perhaps as like a single stock leverage ETF, but in a period of heightened volatility, more back and forth, this thing could chop you up. That's the danger.
Well, so my question is, if you are dollar cost averaging like weekly, does that help offset a little bit of this decay that you hear so much about? Since you're not just putting a big pile in and just leaving it forever.
Maybe. But again, these things are daily products. I've spoken to the people at Direction before about their leverage products, and they say, listen, we do not create these as buy and hold products. These are daily products for traders because of that decay. So that's my word of warning.
When you look, I mean, I know past performance, what they say, but yeah, you look at like a 10-year chart and, you see why so many people are interested. I got email from Rick, a fan of the show, asking just last night after we'd already talked about it.
It does look
Everyone's
nice.
asking about it.
My word of warning is it can go away like that.
Yeah. All right.
That's the problem. All right. Let's do a question.
All right. Up first today, we have a question from
someone
Greg.
in the chat says Duncan looks like a man unconvinced.
Well, no,
always,
I mean,
anytime I give the guy advice, he doesn't. Nothing.
No, I hear you. I hear you, and I will take it into consideration.
I hear you, and I will not listen to anything you just said. All right.
It's a small portion. I mean, well, not that small, but yeah, it's a relatively small portion of my portfolio.
Keeps going up. You're gonna make me look like an idiot. That's fine, right?
Okay. Up first today, we have a question from Greg. Ben used the Seinfeld tipping over the Coke machine analogy a few weeks ago to describe the consumer and economy. Does the same thing apply to the stock market? Hear me out. The yen carry trade debacle a few weeks ago as the initial push. Then yesterday, NVIDIA fell almost 10%. I'm not sure which day this came in, but NVIDIA fell almost 10% while the market was down 2%. Are we getting closer to the Coke machine falling over?
So the NVIDIA, that was, what, Tuesday, I think, or Monday? It was earlier this week. Do we have the video of Seinfeld or not? Do we have that queued up? Did we not do that?
I don't have it.
Okay.
John, do you
All
have
right,
it?
so the Coke machine analogy I mentioned was on an episode of Seinfeld, and Jerry was talking about breaking up with, remember Elaine and Putty? Duncan, I don't know if you ever watched it, but they broke up, they got back together, they broke up, and Jerry was telling Elaine and George, the breaking up is like tipping over a Coke machine. You have to push it and get it rocking a few times before it finally tips over. And I used that analogy with consumers a couple weeks ago, I think on animal spirits. And this question is about it in the stock market. And I like the fact that this is why Seinfeld has staying power, because it applies to so many different parts of life, right? Works on many different levels. So there is an idea to the fact that volatility clusters in the market. So John, throw up the first chart here. I love this one. It's the 25 best and worst days on the S&P 500 going back to the late 1980s. And you can see the red dots are the worst days, the green dots are the best days over this period, and most of the time they occur right around each other. And so it's not like during a bull market you get all these really good up days, and during a bear market you get just these really big down days. People panic sell and panic buy during corrections. And so especially during 2020, that's when we saw most of these. So I have this spreadsheet where I track the daily price moves, new all-time highs, and drawdowns for the S&P going all the way back to the 1920s. So I pulled up my daily price chart, and you can see I have it color-coded because I'm a format guy. So I think this color-coded is, the red is it's 2% or worse down day. The green is 2% or better up day. And this is in 2020 over like a 6-week period. And you can see tons of red and tons of green. You had these huge up 5%, down 5%, up 9%, down 9%, down 12%, up 6%, all like back and forth, just switching back and forth. And this was during a 34% drawdown in the S&P. Now that's obviously an extreme situation. John, you can do chart off here. But in the past month, we've had like a 3% down day and a 2% up day and a 2% down day. So this is a minor uptick in volatility. But the question here is that a harbinger of worse things to come in the stock market? Like a downturn has to start somewhere. And so we've seen this uptick in volatility. Could that be it? It could be. Markets have been running strong for a while now, since they bottomed in, I think it was October 2022. The financial media seems to think that the stock market has its ear to the ground of a slowdown. So John, throw up those headlines here. This is from, I don't know, CNBC and the Wall Street Journal the other day. The stock market fell 2%, and obviously it means that the stock market is worried about slowdown fears and the economy. And my thing is, I looked at this is not just a pithy quote, but the stock market has predicted 5 of the last 1 recession, right? When we've had a big fall in the stock market the last 5 times, only 1 time has there been a recession, and it lasted for 2 months. So it's possible the stock market is forward-looking. It could be saying the economy is going to slow. Another explanation is sometimes stocks just go down, and there isn't really a good reason for it. So John, one more chart here. This is a look at the last 20 years of the number of big down days on the S&P. And so you can see another color-coded Matt, our chart guy, did this for us. Blue is 1% down days, the light gray is 2% down days, and the orange is 3% or worse. Now, even if we took out the really bad years, so let's take out 2008, 2022, 2020. Over the past 10 years, the stock market has been up 8 out of 10 years. But even if we took out, and that's including this year, but let's take out 2020 because that was a huge fall, and then you had a huge comeback rally. So in 7 of those positive years out of the last 8, the stock market has fallen by an average of 1% or worse 23 times on average. And then you get 4 times where it falls 2% or worse. This is during good years, right? So, of course, during the bad years, you're going to get a lot more big down days. But even during the good years, you're going to get these big, huge down days. So I guess the way I see it is there's 3 scenarios right now. The stock market needs a breather, right? And volatility coming back because things were too calm makes sense. 2 is the stock market is predicting a slowdown in the economy. Maybe. Eventually, one of these times the stock market has to be right when it slows down. And 3, sometimes the stock market needs to fall and it doesn't really mean anything. So I don't know how to handicap the 3 scenarios because no one knows what's going to happen in the future. But Buffett called the stock market a manic depressive in the short run. So it's often difficult to discern its intentions. But my way of thinking is if you can't handle one down day of 2%, you probably have too much money in stocks because big down days come with the territory. That's the point.
That makes sense. Something I see mixed up a lot just on social media, a lot of people think when the market falls a lot, that's a recession. And they kind of confuse that it's not a market thing, it's an economic
Well, I think people
thing.
people have been predicting recession for so long that they're looking for some evidence from the stock market. You saw a couple weeks ago when we had the Japan flare-up thing. Everyone said, oh, here we go. This is it. This is finally the stock market is seeing something. So, I think it's a correlation causation thing. And I guess, Duncan, for you, in triple levered ETFs, you got to be like 6% down days are normal, right? 10% down days are normal?
Yeah. I mean, you joke, but yeah, no, that's
right.
no big deal.
Sure, yeah, it's true.
Yeah, no big deal.
All right. Speaking of recessions, we got another one on a recession.
Okay, up next, I hope this isn't like a sign of things to come, but okay, up next we have a question from Brendan. I want to hear your thoughts or any supporting data around the odds of a slow grind into a recession. I feel like unless there is some exogenous event that breaks something, the odds of the economy just slowly wearing down are very low. Corporations are so good at protecting earnings and finding ways to cut costs or increase revenues. Maybe I can't see the forest for the trees, but many of the recessions of memory were on the backs of a pandemic or financial crisis. And they also said they were born in the 90s, so they're not that old, but still.
Let's bring our resident macro handicapper in here, Mr. Barry Ritholtz. I've been reading him since the 2008 financial crisis, I think. Barry, I don't know if there is such thing as a normal recession, but I like where this question is getting at, that the last 2 recessions we've had, and we've only had 2 in the past 20 years, has been the Great Financial Crisis, which was, I don't know, once in a lifetime thing probably, and then the pandemic. So if we're setting baselines here, would you say a more normal recession should be the baseline?
Yeah, absolutely. Those are 2 events that were caused by external, those recessions were caused by externalities. When you think of how exogenous the pandemic was, certainly not economic driven or market driven. Yeah, you could say that the securitizing of garbage mortgages, subprime mortgages was an economic or market-related issue, but it was so much more. It was a combination of the radical deregulation and the very low post-9/11 interest rates, and just so many things came together in a perfect storm. It wasn't the typical. It was a crisis, not a typical economic contraction. For the viewer who wants to think about what should I be looking at to determine if we're going into a recession, I always tell people think in terms of short, medium, and long-term data, right? So short-term data, we track hiring, consumer spending, and wages. They're all doing great. They're literally at all-time highs. 158.7 million people are working in the United States full-time. Last month, the most recent data, that's plus 1.6% year over year. Consumer spending, $19.58 trillion, all-time highs, plus 5.3% year over year. And finally, hourly wages, over $35 an hour. That's, when you think minimum wage is $7.25, up 3.6% year over year. So short term, a lot of stuff supporting the economy.
Nowhere to go but down, though.
Well, or it could just keep trending upwards or just go sideways. So I don't know, when was the last time you saw a massive sustainable pay cut outside of a recession? Usually, and usually it's in the first few months of the recession.
John, throw up our chart here. I looked at all the recessions going back to post-World War II data. We really haven't had a normal recession. I mean, so again, the pandemic was not, the Great Financial Crisis was not. 2001 was kind of a really normal-ish recession, but that was also in the midst of 9/11
And the dot-com implosion.
Dot-com bubble. So that was more of a stock market thing than an economic thing, right? That was a really wimpy recession.
Yeah.
The early 90s, that was a real estate savings and loans kind of crisis. And then the early 80s was recessions that were caused by Volcker. So the last time we really had normal recessions, we're talking like the 50s and 60s. So maybe it has to be an exogenous event, I guess, that causes it. But just a regular slowdown in activity in or normalization, I guess, from the pandemic. That seems to make more sense to me. It's not like we've had this huge debt buildup like we had heading into the GFC, and so yeah, I don't know. It seems like it would have to be something out of left field if we're going to get this crazy event like some people have been predicting forever.
If you're familiar with Laxman Athashan of the Economic Cycle Research Institute, or ECRI, he says the same thing. It's always some external shove, and what determines if the economy slips into a recession or not is how healthy it is. Like a weak economy that's stumbling along and then some exogenous shock comes along, that'll cause a recession. A healthy economy, like we've had over the past couple of years, low interest rates, a ton of fiscal stimulus, pent-up demand from consumers who were locked up for 2 years and suddenly outspending. That's why that healthy underlying set of data is why...
And maybe hopefully the good news this time is that the shove is being done by the Fed. It's not being done by some other crazy... The Fed is doing it, so they can hopefully step in and turn around or fix it if they do break something.
Well, and I was going to say, so the first three, consumer spending, wages, were short-term. Medium-term is interest rates, and the Fed already did their damage. I did a post a couple of years ago. The Fed is raising rates too quickly, and they're breaking things. And that was right as Silicon Valley and First Republic back went belly up. But here we are. It's the beginning of September. We're about to see the first of, I don't know, 2, 3, 4 rate cuts over the next couple of months. And historically, that makes it less expensive for consumers to buy things like cars and houses and to carry any sort of debt on credit cards. So that's medium term. That's a positive also. And then lastly, long term, we look at government policy. This administration has passed 4 long-term policy plans. The last administration passed one 10-year policy plan that was very stimulative, the 2017 Tax Cuts and Job Act. Then they passed the CARES Act 1 and 2, which is what helped lead to that bout of inflation. The CARES Act 3 under this administration also is a contributing factor. But this administration has passed the Inflation Reduction Act, the Semiconductor and Manufacturing Act, the Veteran Pension Act, the Infrastructure Plan. All of these are 10-year plans, and that can't be touched. That's already in motion.
Good luck slowing the train down, right?
Yeah, I mean, and the difference between the 3 CARES Act, that was like $4 trillion just dumped on the economy in 18 months under 2 different presidents. This is going to be 10 years. Theoretically, this could be over, 3 different administrations. And it's not going to be as aggressive or inflationary, but it's an underlying source of economic tailwind. So one day there will be a recession. I don't know what's going to cause it. Maybe it's an oil shock. Maybe it's a war that spills over into Europe. I have no idea. I'm just guessing. But it's hard to see anything on the immediate future that says the economy is about to go into recession. And last point, I think we really have to separate the concept of the economy is slowing down versus the growth rate of the economy is slowing. So we're not contracting. We're not going 60 miles an hour anymore, but we're still going 30. Like the rate of travel is still positive.
Yes.
It's just not as fast as it was. And, you could use the word normal, 2.5% GDP. Like 5% GDP for a $25 trillion economy as mature as the United States, clearly not sustainable and all driven by all the post-pandemic craziness.
Yeah, which is mostly gone.
That's right.
I think we're making econ professors really happy today with all the use of exogenous. It's a really good word. Yeah.
It's a great word.
Yep. All right, next question.
All right, up next we have a question that came in from Twitter, Honeybee. If you're 50 years old with a 30-year mortgage rate at 2.75% interest, does it make sense to pay it off early? I'm struggling with this. Thanks to Dave Ramsey. This is actually a topic. Shout out to Jill on Money. We just posted a video last Saturday that's about this very topic.
People have
Is
very
this a
strong opinions
question?
about this.
Is this a question or a humble brag?
Well, yes, a little
Maybe
bit.
a little
you-
both.
Yeah, you're right. You pay off your mortgage or you keep 2.75. You're pretty fine either way. People have very strong opinions on this, and I don't think you're going to change people's minds. But so Dave Ramsey is a strong one of pay the debt down regardless. You do not have debt.
Dave Ramsey made me feel so bad about my student loans when I watched an episode years ago.
Wrong.
It was like
I
he
just
gave me
think
panic.
I just think you'd be crazy to pay off a mortgage that's negative on a real basis, and you have the tax breaks that you get from it. I understand why some people would want to pay off a mortgage in a 6 or 7% world. I think that low of a rate completely changes the equation. And some people say, listen, spreadsheets don't always matter. It's also how you feel, and some people feel better when they pay off debt. I still don't get it. So I think you're a pretty good spot either way. The thing is, the one thing people always say is, well, if I pay off the debt, then I'm safer, right? And to me, what's safer, holding on to that cash and having flexibility, or putting it into an illiquid asset that you can't spend? So you're actually safer holding the cash, even if the Fed lowers rates. Let's say they get to 4%, you're still getting more than you would in that mortgage. It just doesn't make any sense to me to pay off a rate that low.
Ben is 100% right. Dave Ramsey is 100% wrong. There's no shades of gray here. You will never get a 2.75% mortgage in your lifetime or anybody else's. That's the all-time low. You're not going to see better than that.
I wish I would have borrowed more money back then.
Right? Oh, my God, right? Everybody should have backed up the truck. And the question today is, what are the opportunity costs for paying that mortgage down? Schwab's money market fund is yielding over 5%. It's like 5.1
That's what I was about to say.
something
Treasuries
percent.
are paying double that, right?
Right.
I mean,
So at the very least, you're giving up nearly 2.5% free money for just saying I'm going to continue to pay the mortgage. But if I pull the money out of my money market account to pay off the mortgage, and by the way, that's one of the safest things you could do. You put the money in the stock market, and while you'll have more volatility, over the long haul, you should expect 8% returns. So it makes no sense. Look, if we all talk about having an emergency fund. If you check every box in the world and you have everything fully funded and you have 6 months cash or whatever it is, and you're somehow not sleeping at night because of your 30-year 2.75% interest rate mortgage, and it brings you some degree of security to pay it off, I think it's a mistake. But if that's what lets you sleep at night, go ahead. For the other 99% of people out there, why the hell would you pay off a 2.75% mortgage? You know, it's you give up you give up the cash that's doing better. You give up the lowest rate in your life. You give up the deduction. It just doesn't make any sense.
My 3% mortgage helps me sleep better at night.
Right? Because it could be 7%. Although they did come down to like 6.3 after the Powell presser.
Yeah.
Do you
I
think
think
Dave
this
Ramsey
is
just
pretty
started
easy.
out talking to people about having too much credit card debt, and then he was just like, you know what? I'm just going to be against all debt.
He's just an anti-debt guy, yeah. Whatever. Don't listen to us or Dave Ramsey, I guess, but do what makes you happy, but don't listen to Dave Ramsey.
Can I
But if
tell
you
you
had to
something?
pick-
Here's my problem with the all debt is bad. You know, debt is a tool. Money is a tool. And a hammer is a tool, and used correctly, you can build things with it. Used incorrectly, you run into trouble. So I hate these, like, it's back to the never buy a latte, don't buy a sailboat. You know, it's the just overly broad budgetary nonsense. If you are responsible and you have a very low interest rate, why would you want to pay that off? It makes no sense.
Right. His advice makes sense for credit cards, not for 3%
Right.
mortgage.
Exactly. Yeah.
Hey,
yeah. That's what
why
I'm saying.
carry credit card debt? By the way, credit cards are now running 15, 17, 19%. I run everything through the Chase Sapphire card, and then it's paid off at the end of the month. I pay no finance charges. I pay whatever the upfront fee is, and I get it back pretty much in airline
And usually
perks and upgrades.
the problem is most people, Ramsey's talking to a different subset of people
Yeah.
in personal finance, and some people can think that they have to take that mindset forever. And you
Right.
can eventually graduate from that mindset to a new one.
Excellent.
Yeah, having a 24% interest rate on a credit card that you're carrying a balance on is a little different than a 2.75% mortgage.
10x. It's
Yeah.
crazy.
All right, next question.
All right, up next we have a question from Harsh. Big follower and fan here from the UK. I'm 43 and have been working in banking for the last 18 years. I did not realize the power of investing until the last few years when I started investing in India. I'm Indian, and until then lost a lot of purchasing power due to cash holdings. I started doing monthly benchmark index ETF purchases for Dow, S&P, and XLK, that's the tech ETF, in equal proportions after the COVID crash in 2020. And in the last 4 years, the investments have become meaningful along with material profits, $500,000 plus, driven by the tech sector run-up. On the other hand, I know it pays to stay invested in the market. Or on the one hand, I know it pays to stay invested in the market, but on the other, the profits are difficult to ignore. I'm not yet fully invested with some cash remaining to be invested.
I think this question is a
They
good
kind of answered their own
reminder.
question, right?
Well, they're in a roundabout way. They're saying, "How do I invest?" Basically, but I think this is a good reminder that just because someone works in finance does not mean they were good at their finances. And I think Barry, you've probably ran into a lot of people like this that work in some sort of like investment banking or whatever. Like, and these people spend all their money and don't save and invest. But this person who, he said 18 years or so, just built up a pile of cash. And I'm sure if he's working in banking, maybe he has enough money set aside, but never figured out how to invest. So he's basically learning on the fly how to be an investor. And my point here is that he's figuring out, I hold some tech stocks and some index funds, but what do I do with the profits? It's like Nick Murray always says, there's a difference between a portfolio and a plan. And he has a portfolio, but it doesn't sound like he has a plan yet. And I think that's the thing. The hard part is most people learn on the fly as they're slowly but surely building their balance up, and they can make a few mistakes and pay tuition to the market gods. But he already has a big chunk of cash.
Right.
And so those mistakes are going to be more meaningful for him. So I'm curious what you think about trying to learn how to be an investor when you already have a big chunk of money.
So first, full disclosure, we have a number of clients who work at various hedge funds and on Wall Street, and the thing I've heard over and over from them is, look, I trust you guys to handle it. I can't think about my personal portfolio when I'm trying to do my job, either trading or running money. So it has to be just out of my sphere of influence. Otherwise, it's going to affect my day job. It's really interesting.
And their specific, what they do could impact the way that they invest too, right? I'm in this specific sector, so
right.
I
don't
need
even
to
want to know
diversify
about it.
away
You
from
guys do what
right.
you're going to do. I just can't get into my head. So it's kind of interesting. Second, I got to point out that Harsh is 43. And while there's a bigger social safety net and retirement funding in the UK, he still has at least 20 years of working before he's going to need this money, assuming he's investing for retirement. He doesn't say exactly what he's investing for, so I'm going to assume it's for retirement. So if you don't need the money for 20, 25 years, I mean, he seems somewhat diversified. I wouldn't say the Dow, S&P 500, and XLK in equal portions are diversified. So he might want to think about having some other exposure to other parts of the market. But what is he going to do with the profits if he sells here?
That's the thing. Asking about the profits makes me feel like he probably is taking more risk than he's comfortable with. Mm-hmm. So I think being a little more diversified and having some fixed income or cash holdings is actually okay as he's learning to deal with losses and volatility. So I'd be fine with him slowly but surely dollar cost averaging the rest of that cash in and not being in a hurry to get it invested right away.
Nothing wrong with that. I would ask, why the Dow? Like it's such an old and irrelevant index. Wouldn't you be better off? Again, I don't know his personal situation. Wouldn't he be better off with something like the Vanguard Total Market or a global BlackRock Total?
To be fair, the Dow basically follows it though.
Yeah,
more or less.
Kinda. There's a lot of overseas exposure. It just seems like
you don't
it's
hear
always
that many people investing in the Dow anymore. That's true.
Right. You don't.
It sounds
and
cool to say though.
It's just a laggard to the S. It's not as diversified as the S&P 500, and it doesn't do well. And while I'm loath to tell anybody to invest internationally because it's been such a underperformer for so long, I mean, can he just have his whole portfolio as a British resident invested in the U.S.? There's currency risk there. Maybe he wants a little. And by the way, Europe has just stunk the joint up for 10 years.
Yeah, some more diversification makes sense to me too. I think the biggest thing is he's got to settle on some sort of investment plan or strategy. Here's my asset allocation. Here's when I'm going to rebalance back to that asset allocation. And I'm not going to, I'm not going to tinker. I'm not going to try to jump in and out and take profits or whatever he's trying to do.
Except in Dogecoin. He can sell his Dogecoin if he wants.
Figure that part out of it first, though. That's the thing. And maybe don't listen to your banking friends about what to buy and sell.
Yeah, the last point on this is we talk about meaningful versus meaningless capital, right? I think about Archegos and the guy who ran up a pile of money to $20 billion and then crashed and burned and went bankrupt. That was purposeless capital. He did that for the sole purpose of more. That was his only goal, more, more, more. If you're saving for retirement, to pay for your kid's school, generational wealth transfer, philanthropy, whatever it is, there's a purpose, and towards that aim, you can figure out what's the appropriate amount of risk you want to take and how do I diversify down to that risk level. This is a pretty concentrated run and gun, high volatility portfolio. So if he's comfortable with plus 20%, minus 20% over the course of, the next 10 years, then fine. But he's kind of $500K for someone who's 43 I wish I had that much when I was 43.
You're right. Tie it to the goals first.
Yeah.
That's
that will determine what your risk profile looks like.
In your experience, do most people who kind of luck out and have a big investment in tech, for example, that ran up so much recently, do they stay risky with their portfolio, or do they then say, you know what, now I'm going to get really conservative?
So, quick war story. A buddy of mine started working for a company in the 90s. They got bought by Yahoo. By late 99, when his stock vested, everybody, and the stock was just going up and up. Everybody was freaking out. And the question, he didn't know what to do. Nobody there knew what to do. And the question I asked him is, what makes you feel worse with this pile of winnings, lottery winnings? If you sell half and it keeps going up, or if you don't sell anything and everything goes down, sort of a regret minimization framework. And the answer was, if I sell half, that's real money. It covers my mortgage, my kids' college, and probably our retirement. I still own half of my stock, so if it keeps going up, it's great. But if I don't sell anything and it crashes, I'm going to feel miserable for years. So for lottery money, and I don't know if I would call 500.
So wait, did your friend follow your advice?
He did, and actually, it's probably the greatest advice I've ever given anyone. And P.S., a lot of other people at Yahoo was like, "Dude, this was before hodlers and to the moon. This was just late in the .com bubble. A lot of people didn't sell, and they really regret it. I mean." Yahoo peaked at like 260, some crazy number. And remember, the Microsoft offer was 10% of that was like $29. So
I think crashed big. Yeah.
Yeah, giant. And so sometimes when, again, not 500K in the S&P 500, but when you really win the lottery, we had someone reach out to the office. Hey, I'm sitting on $40 million worth of Bitcoin. I don't know what to do. I drive a truck for FedEx. This is like 3 or 4 years pre-pandemic. It's like, well, that's a lot of money. Think about selling half and writing the rest. And because $20 million changes your life and your children's life, like sometimes you got to say, hey, that's a home run.
Right. You always say, like, the difference between 20 million and 30 million is not going to change your life.
Right. My favorite joke to clients who are ultra wealthy is, what's the difference between $1 and $2 billion? And the answer is nothing. Your lifestyle is exactly the same. There's no difference. All right, maybe you could buy a few extra Monets. Other than that, there's no difference.
Duncan would have way more hats if he had $2 billion.
I think if I had a massive run up in something, I'd probably lose the levered funds. I think I would.
Because you don't need the risk.
Exactly, yeah.
All right. One last question.
Last but not least, we have a question from Samuel. I know you guys discuss home purchases often, but one of the other major purchases people make is, of course, their car. I have a 14-year-old car that I need to retire. It has some minor dings, but runs well. What's the best way to sell a used car these days? I don't want to nickel and dime the sale and would prioritize convenience within reason. We will obviously need to get a new car, but our needs may change in the near future, a new kid or two. and I want to maximize resale value to stay flexible. Any guidance?
All right,
I have
Barry,
a story
you're a car
here,
guy.
but I'll let you guys. Yeah,
Yeah.
you guys.
So really interesting question. First, good on you getting a new car with the latest, greatest safety features for your wife and eventual kids. I strongly advocate not driving 20-year-old. Can I say shit boxes? Are we allowed to use that language? Because they just lack the modern safety features. So 3 solutions for cars depending on their age and value. Is it a collectible car? Is it an older, junker, or is it something in between? If it's a collectible car, well, then go to things like Bring a Trailer or Cars and Bids and spend some time to have professional photographs taken and sell the car that way. These are for like old 911s and sports cars and modern, BMWs and Porsches and things like that. That's where you get top dollar on, sports and collectible cars. If it's the opposite end of the spectrum, if it's, a car that's 10 or 20 years old and has high mileage, I know a number of people that have done really well with Carvana. You go to the website. By the way, not a paid endorsement. My brother sold a car through Carvana. My sister-in-law did. I know a few people did. A car, my sister-in-law's Jeep.
That was my story. I sold
really?
one. Yeah.
20.
Yeah.
Her Jeep was 20 years old. We filled out the paperwork online.
And they just offer give you a price?
They give you a price. You look up the price online. It seemed pretty fair. And when they showed up, I'm like, what are you guys going to do with this car? She's like, hey, there wasn't a way to disclose this. The sunroof leaks. We had it fixed, but it's kind of a persistent problem with this model Jeep. Guys, like anything over 10 years is worth more in parts than it is as a vehicle. So Carvana is the older solution.
See, I think that makes sense for people, especially because, as opposed to like the Craigslist or listing it yourself, because then you have to go through the title transfer and the registration,
Right.
and you have
They
to do
took
all
care
that
of all that.
yourself.
Yeah.
Certified check. They put it on a
pain in the
flatbed
butt.
and off they go.
Yes, and
Couldn't have been easier.
I've done it through a dealer too, and I think the one other way you can do it is if you're buying a new car, use it as leverage for the dealer. So I've done that in the past where I'm going to get a new car, I'm selling my old one, and I'll say to the dealer, will you buy this from me too? I sold a Nissan Altima or something when I got my first SUV because I had kids, and they kind of gave me the price of the car, and then I said, oh, also I have this trade-in, what will you give me for it? And I looked at the Kelly Blue Book or whatever it is online, just to make sure they were close, and then I used that. I said, why don't you give me $2 more grand for the trade-in, and that as a way to help me get it off, and a lot of the dealerships will take it from you too.
So I'm glad you brought that up for a couple of reasons. First, when you're negotiating a car purchase, always negotiate the price separately from the trade-in or the financing, because it's almost like a shell game and they can hide the real price of the car. So you did that right. You negotiated the car and then the trade-in. Second, look, they're a for-profit business. You got to be a little wary of car dealers. I mentioned Bring a Trailer. We have a client that had a late 2018, 2019 Porsche 911 GT3. The dealers offered him $200,000 to take it on consignment, and they were going to take like a 25% sales commission, which meant it would have been $150 to him. We were like, don't do that. We'll put it on Bring a Trailer. We know those guys. So, some of their, we've worked with Bring a Trailer both personally and professionally. And we got this guy $229,000 for a car to sell it, coincidentally to somebody one town over, that the car dealer was going to offer him $150. $80,000 on a car is a giant amount of difference. He was thrilled to death.
That's true. The value of it probably depends more on if you're haggling over $500 something, that not worth the headache. But if it's tens of thousands of dollars,
one of those
it
you can sell, something like that you can sell and Bring a Trailer. I'm curious, Duncan, what was your Carvana experience like?
Oh, it was super simple. Again, not an ad, but hey, maybe they'll be sponsoring next week's episode. Right. But yeah, earlier this year I sold my Model 3 and
what'd you get for it?
How much?
Yeah.
I don't remember right off, but it was more than what we owed, and we drove it for 3 years, 36,000 miles.
Wow.
Never had any maintenance, didn't have to do anything to the car. So yeah, we sold it for. What I will tell you is, they keep going down on the offer.
Yeah.
So like just a pro tip there, like the first offer that you get
Is usually your best one.
Probably the best because they
interesting.
update it week in, week out. So each week you get a new updated price.
And it's
You get
now
a
a
premium
week
for
old.
hitting the button right away.
And so exactly. So I'm sure it doesn't always work this way, but ours, we ended up missing out on like $2,500 because we
Really?
didn't take the first one. We waited a few weeks, and it went up and down a little bit, but we ended up getting less, a couple grand less.
And they pick it up from you, right? They come
So
get
they
it?
will, but we had one in Westport, Connecticut. We just drove it to. But yeah, they will. I think they said that they were going to charge us $100 to pick it up. So I was just like, I'll just drive
Who
it over.
cares, right?
Yeah.
Done. It's my sister-in-law sold this 20-year-old 95,000-mile Jeep for $5,000. My brother had an old Jag, and he just exactly what you're talking about. Not a collectible, like a 10-year-old Jaguar. Was just about to start that depreciation curve. And he sold that also. He sold it for what he paid for it like 2 years earlier. So he was thrilled. If you have something in between, an old, junker like that, or a collectible type of 911 type of car, I know people, I've never done it, but I know people who have had some success on Facebook Marketplace. You just have to be prepared to deal with, the headaches of humans kicking the tires. And
Yes, it can be a lot. Duncan,
Right.
the Model 3 was the best trade you've ever made. It's better than any of your stock trades.
Yeah, Dave in the chat is saying that too. Yeah, we timed it pretty perfectly because just the prices of used Teslas kept dropping right after that. So yeah, we did well. Drove the car for 3 years. I never even rotated the tires. I kept track. I watched them. They wore completely evenly. It was it was a great experience.
Would you
But
buy
yeah,
another Tesla?
I have another one. Yeah,
You did. What'd you end up replacing the Model 3
A Y.
with?
We got a Y.
Right.
We just
How do you
wanted
like
a
it?
bigger. I love it. It's
Yeah.
my favorite car I've ever had.
Wow.
Yeah.
Duncan's greatest trade.
I
ever.
would
Very
like a
good.
Rivian R1S too, though. But yeah.
Jay just got one, and he loves it. Jay
Yeah.
in our office.
All right, good question though. Like you're right. People don't probably talk about this enough, and it's not something you do very often. So most people probably don't have a good
This is
strategy.
becoming a car podcast.
By the way, my advice is if you buy cars, sell a car. Don't let them just accumulate in your garage and driveway. Otherwise, you just run out of space really quickly. That's just my
I haven't had that problem yet.
Some people we know. All right. Thanks to Barry for coming on. As always, check out The Big Picture, Masters in Business. Appreciate you, Barry.
My pleasure.
Thanks,
Send
Barry.
us an email, askthecompoundshow@gmail.com. Thanks to all the people in the live chat. Thanks for people watching live on Twitter. Leave us a comment or question on YouTube. Subscribe, rate, review, all that good stuff. We'll see you next time.
See you, everyone.